You've worked hard your whole life, maybe 30 years, maybe 40 years. You woke up early. You went to work even when you were tired. You saved money when others spent it. You built your 401k. You invested in mutual funds. You paid off your house, or you're close. And now retirement is finally near, maybe 5 years away, maybe 3, maybe even 12 months away. And you're thinking, I made it. I'm safe now. But I need you to hear this clearly. The 5 years before retirement are the most dangerous years of your financial life, not because you did anything wrong, but because in this period, one big mistake can destroy everything. One market crash, one panic decision, one wrong withdrawal plan. And suddenly, the retirement you dreamed about turns into something else. Working part-time at 70, worrying about every bill, skipping travel, living with fear, watching your savings shrink. That's why this video matters, because if you're about to retire and the next market crash hits, you need to know exactly what to do before it happens. Let's talk about it. Why Warren Buffett never panics. Warren Buffett has seen everything. He has lived through recessions, wars, inflation, interest rate, spikes, market crashes, housing collapses, tech bubbles. And through all of it, he stays calm. Why? Because Buffett understands a simple truth. You don't lose money when the market goes down. You lose money when you panic. Most investors do the opposite of what they should do. They buy when things feel safe. They sell when they feel scared. And that is exactly why people lose their retirement, especially near retirement. The retirement trap. Most people fall into. Here's the trap. When you're young, market crashes don't scare you as much because you have time. If your 401k drops 30% at age 35, you can recover. You have 25 years. You keep contributing. You keep buying. You let the market come back. But what if you're 62? What if you retire at 65? Now you don't have 25 years to recover. You have maybe 3 years, and that is where things change. A market crash near retirement doesn't just hurt your portfolio, it can ruin your entire plan, and most people don't realize this until it's too late. Let me tell you a true story. Let me tell you about a man named Mike. Mike worked for the same company for 39 years. He was not rich, but he was responsible. By age 61, Mike had $900,000 in his 401k, a paid-off house, no major debt plans to retire. At 65, Mike said, I'm finally free. Then the market crashed, and his 401k dropped fast. Within months, his $900,000 became around $600,000. Mike panicked. He said, I can't lose more. So he sold everything. He moved to cash. He stopped investing. That was the worst decision he could make, because the market eventually recovered, but Mike was no longer in it. He sold low, and when prices went back up, he missed it. Mike had to delay retirement. He worked until 70, and even then, he retired with less confidence, because he never rebuilt what he lost. Now here's the sad part. Mike didn't lose because the market went down. Mike lost because he sold at the bottom. That's what crashes do to people. They create fear, and fear causes bad decisions. The number one retirement danger, sequence risk. There is a specific danger in retirement called sequence of returns risk. It sounds complicated, but it's simple. The timing of your returns matters more than the average return. Let's make it clear. Imagine two retirees, both retire with $1,000. Both withdraw $50,000 per year. Both get the same average return over 10 years, but one person gets a big market crash early, and the other person gets the crash later. Guess what happens? The one who gets the crash early runs out of money faster. Why? Because they are withdrawing while the account is down. They are selling investments when prices are low, and once those shares are gone, they can never recover. That's sequence risk. And it's the biggest reason retirees run out of money. Warren Buffett's big idea, Buffett's strategy has always been buy quality, don't panic, stay invested, think long-term, protect your downside. But here's what most people misunderstand. Buffett is not saying, put everything in stocks forever. Buffett is saying, use the right strategy for your life stage. When you're young, focus on growth. When you're near retirement, focus on protection. That means if you're retiring soon, you need a plan that can survive a crash, not just a plan that looks good when markets go up. The 6 mistakes that destroy retirement and how to fix them. Mistake number 1, too much money in stocks. If you're 5 years from retirement and 80% of your money is in stocks, you're playing with fire, because if the market drops 30%, your retirement drops 30%, and your timeline changes instantly. Now, I'm not saying no stocks, but you need balance, a simple guideline. If you're retiring within 5 years, your portfolio should not be overly aggressive. A practical range: 40% to 60% stocks rest in safer assets like bonds, treasuries, cash reserves, CDs, or stable funds. You don't want to be forced to sell during a crash. You want enough safe money to survive the storm. Mistake number 2, no cash buffer. This is a huge one. Most retirees don't keep enough cash. They retire with their money fully invested. Then the market crashes, and they still need to pay bills. So what happens? They withdraw money at the worst time. A better plan: have 12 to 24 months of expenses in cash or cash-like assets. This cash buffer protects you. It means even if the market crashes, you can live off cash and avoid selling investments at low prices. This one step can save your retirement. Mistake number 3, wrong withdrawal strategy. Many people think, I'll just withdraw 4% and I'll be fine. But the 4% rule is not magic. It was based on history and assumptions. Today we have longer lifespans, different market conditions, inflation risks, lower bond yields in some cycles, so you must be flexible. Instead of one fixed rule, you need withdrawal ranges, spending flexibility, cut back during bad years, increase during good years. If the market drops 25%, that is not the year to buy a new car. That's the year to protect your account. Mistake number 4, taking Social Security. Too early. Social Security is one of the best tools retirees have, but people rush it. They take it at 62 because they're scared. But here's the truth. If you take it early, your benefit is permanently lower. If you delay, your benefit grows, and the increase is guaranteed. That matters because Social Security is inflation adjusted. It's stable income, and stable income reduces your risk of running out of money. A smart approach is, if you're healthy and can afford it, delay Social Security, especially for married couples. The higher earner delaying can protect the spouse for life. Mistake number 5, underestimating healthcare. Healthcare is not a small cost. It can be your biggest retirement expense. Many people retire at 62 or 63 before Medicare starts at 65. Then they face expensive private health insurance, large out-of-pocket costs, surprise medical bills, and even after Medicare, Part B premiums, Part D drug plans, Medigap Advantage costs, dental and vision hearing aids, long-term care risk. If you don't plan for health care, you will be forced to withdraw more money. More withdrawals, higher chance of running out. Mistake number 6, no tax plan. Taxes can quietly destroy retirement. Many people have traditional 401ks, traditional IRAs. That means every withdrawal is taxable. And later in retirement, RMDs force withdrawals. Those forced withdrawals can push you into higher tax brackets, increase Medicare premiums, cause Social Security taxation to rise. Smart retirees plan early. They use strategies like Roth conversions, tax bracket management, timing withdrawals wisely. Using taxable accounts strategically, even small tax planning can save tens of thousands. What Warren Buffett would do before retirement. Now let's answer the big question. If Warren Buffett was retiring in 5 years, what would he do? Here's what Buffett would prioritize. 1, a plan that survives a crash, not a plan that only looks good in bull markets. 2, a simple portfolio. Buffett doesn't like complicated products. He likes simple. 3, enough safe money. so he never has to sell during fear. 4. Emotional discipline, because the real enemy is panic. The crash-proof retirement plan. Let's talk about what you should do. Step 1. Know your number. How much do you spend per month? Not what you guess, not what you hope. Track everything for 90 days, then multiply by 4. That's your annual spending. Then add 15%, 20%. This gives you a real retirement budget. Step 2. Build a cash runway. Have 24 months of expenses set aside. This cash runway is your protection. It prevents forced selling. Step 3. Rebalance your portfolio. If you're too aggressive, reduce the risk now, not after the crash. After the crash, it's too late. The best time to prepare is before fear enters the market. Step 4. Stress test everything. Ask these questions. What if the market drops 30% in year 1? What if inflation stays high for years? What if I live to 95? What if I need long-term care? What if I support a family member? If your plan can survive these, you are ready. If it breaks, you need to adjust now. Your 60-day retirement protection checklist. If you are retiring within 5 years, do this in the next 60 days. List every account and total your net worth. Check your asset allocation, stocks versus safe assets. Create a 24-month cash buffer. Track spending and build real retirement budget. Run Social Security numbers and decide timing. Estimate healthcare costs before and after 65. Review tax strategy. Roth conversions, withdrawal plan. Stress test your retirement plan. Create a plan for what you'll do in a crash. Write the rules. I will not panic sell. This is how you protect your retirement. The most important part, your mindset. Let me tell you something important. Retirement is not just numbers. Retirement is emotions, fear, greed, panic, regret. A market crash does not destroy you. Your reaction destroys you, so you must prepare mentally. Write this down. In the next crash, I will not panic. I will follow my plan. I will protect my future. Because the people who win are not the smartest. They are the calmest. Final message. You work too hard to lose it now. Don't let one crash take your freedom. Don't let fear steal your retirement. The next market crash will happen. Nobody knows when, but we do know this. It will scare people. It will make headlines. It will make you feel like you should do something. But if you prepared correctly, you will not panic. You will be protected. You will be ready. And while everyone else is selling in fear, you will stay calm. That's the Warren Buffett way. That's how you retire with confidence. Call to action. If you're within 5 years of retirement, save this video, watch it again, and start your 60-day plan today. And if you want more straight talk retirement content, subscribe, because retirement isn't built on luck, it's built on planning.